Every year, thousands of W-2 earners unknowingly overpay 20, 50, and sometimes even hundreds of thousands of dollars in taxes. Not because they did anything illegal or filed their taxes wrong, but because they did not realize this one thing. And by the time they do, many people realize they've already overpaid. And that's why so many high income earners walk away from tax season feeling like they just wrote a massive check to the IRS and they did not have to. For those of you who are new here, welcome. My name is Alec Friel, founder of Tax Saving Experts. And in the last 12 months alone, we've helped over 270 high income W-2 earners legally save over $12 million in taxes using strategies most people never hear until the year is already over. In this video, you're going to learn the $50,000 tax mistake most W-2 earners do not realize they're making, the key tax planning windows high earners miss every year, and how smart W-2 earners structure their taxes to be able to keep more of what they earn and build real long-term wealth. Let's start with the misunderstanding that causes the entire problem. Most people think that their CPA lowers their taxes when they file their return, but that's not really what filing does. Filing is mostly reporting. It's looking backward and telling the IRS what has already happened. Your income already happened. Your deductions, investment gains or losses, withholdings either happen or they did not. And by the time the return is being prepared, most of the outcome is already locked in. And that's why filing taxes and planning taxes are two completely different things. Filing is compliance, planning is strategy. Planning is what changes the results before the year ends. And that's the part most high income W-2 earners are missing. They assume because they have a CPA, they have tax strategy. Not necessarily. A lot of people have a tax preparer. Very few people actually have year-round tax planning, and that's the real mistake. 99% of people are treating tax planning like tax filing, meaning they wait until filing season to think about something that should have been handled throughout the year. And that's the moment the viewer usually realizes their tax problem did not just start in April. And once you understand that difference, a much bigger realization hits you, because the real deadline for many strategies that could save you $20, $50, $100,000 or more in taxes is not in April. It's December. Most of the tax saving moves that actually mattered are controlled by the calendar year, not the filing date. That means the IRS usually cares about what happened by December 31st, not what you wish you had done by April 15th. That's a huge difference. And because once a year closes, many of the best opportunities are gone. You can't go back and decide to make smarter HSA moves after the year ends. You cannot retroactively bunch charitable deductions into a prior year. You can't go back and adjust how you handle the big RSU vest that already happened months ago. You cannot rewind to harvest investment losses in the right window. You cannot suddenly create business deductions after the tax year is already over. By the time most people are seriously thinking about taxes, most of the meaningful moves are already unavailable. Now let's look at the specific tax moves people miss most often, because this is where the $50,000 mistake usually starts to build. Let's start with one of the cleanest tax strategies in the code, the HSA, also known as a health savings account. A lot of people know what an HSA is, but very few people use it strategically. Most people treat it like a healthcare spending account. They put money in, they spend it as soon as the medical bill shows up. And technically, yes, that works. But that's not where the real power is, because the HSA is one of the only accounts that gives you 3 tax wins at one time. You get a tax deduction when the money goes in, the money grows tax-free while it stays invested, and if used for qualified medical expenses, it comes out tax-free too. That's a triple tax advantage, but that only becomes powerful if you actually plan around it. Smart W-2 earners don't just throw money into the HSA as an afterthought. They make sure it's funded properly. They understand the contribution timing. They invest the balance, and if cash flow allows it, they avoid draining it right away. That's how the HSA stops being a simple health account and starts becoming a serious long-term tax tool. This is the point where people realize even something as simple as an HSA becomes a meaningful missed opportunity if they don't think about it early enough. But the HSA is only one example. Another big tax leak shows up in a place where many high earners already think they're doing the right thing: charitable giving. Quick pause. If this video is making you realize there are far more legal tax strategies available to high W-2 income earners than most people ever hear about, that's exactly why we created our free school community, which you can join using the second link below. Inside, you'll find step-by-step guides, training replays, and ongoing Q&A support built specifically for high-income W-2 earners who want to stop overpaying, start using these strategies the right way. So if you have not done already, join join now. So I'm sure a lot of you are giving generously, and that's a great thing. But many of you most likely are structuring it in the least tax efficient way possible. You give cash every year, small or medium amounts, same charities, the same schedule, same generosity. And then you're surprised when the tax benefit barely moves the needle. Why? Because the standard deduction often swallows up most of its value. So even though you're doing something generous, you're not actually doing it strategically. And that's where better planning changes everything. Instead of giving the same way every year and hoping the return reflects it, smart W-2 earners look at bunching deductions into higher income years. That may mean a donor advised fund. That may mean contributing appreciated stock instead of cash. That may mean matching larger charitable deductions to years with RSU income, bonus income, or unusually high compensation. The exact same generosity, but using better timing. And that results in a much better tax result. Giving more is not always the answer. Giving smarter is. And this is where many viewers realize they may already be leaving tax savings on the table through generosity alone. Now, let's move to one of the most expensive mistakes of all, equity comp and bonus planning. This is where a lot of high earners get crushed, especially in tech, finance, executive roles, because many people assume RSU taxes are already handled. They see withholding come out, they assume the problem is solved, but usually it is not solved. It's just delayed. Default RSU withholding is often far too low compared to the actual marginal tax rate of a high income W-2 earner. So when the income hits, the tax bill is not gone. It's just waiting. That's why people get shocked in April. They think, how do I owe this much? I thought taxes were already taken out. Not enough of them were. And if there's no coordinating, planning, invest dates, withholding adjustments, tax loss harvesting, cash reserves, and diversification strategy, the result is usually the same. A surprise tax bill that feels way bigger than it should. The key point here is very simple. The tax on RSUs often is not gone. It's just postponed until April. And if you don't plan around the income event when it happens, April becomes a very expensive month. And this is where high earners and tech finance executive roles feel the pain very differently. And there's one more place high earners lose a lot of money, not because of what they invest in, but because of how they're structured. As you know, pure W-2 life leaves most people paying for everything with after-tax dollars. And that's one of the common frustrations of being a high-income employee. You make great money, but by the time that money hits your account, taxes have already taken a huge bite out of it. Then you pay for tools, technology, travel, education, and opportunity using what is left and what's remaining. That's where the structure starts to matter, because once a legitimate business enters the picture, a completely different part of the tax code opens up. Section 162A allows deductions for ordinary and necessary business expenses. And that means when you have real business activity, certain costs may be handled before tax instead of after tax. Now, I'm not talking about fake business or forcing something that does not exist. I'm talking about a real side business. It could be consulting, advisory services, content creation, coaching, specific niche services, something with a real profit motive. And once that structure exists, the door opens to things like your home office, your phone and internet, software and different equipment required, travel, education, and so much more. And that's why a side business is often the first major unlock for a high-income W-2 earner. It does not just create another income stream, it changes the rules around what can be deducted. And that's exactly what makes this mistake so expensive. It's not just one missed move, it's several small misses stacking together. And this is the part of the video where the title pays off, because the real cost usually is not one giant dramatic error. It's the accumulation of several missed opportunities in the same year. Maybe someone misses a fully optimized HSA strategy. Maybe they give generously, but structure the charitable deduction the wrong way. Maybe their RSU withholding is way off. Maybe the missed tax loss harvesting opportunities where markets drop. Maybe they never create the business structure that opens up legitimate pre-tax deductions. Individually, each one might not sound catastrophic, but stack several of these on together in 1 year and suddenly the number gets very real. That's how people overpay by tens of thousands of dollars without ever realizing where the money leaked out. Now, that's exactly how this becomes a $50,000 mistake. Not through one giant disaster, but through a series of missed opportunities caused by waiting too long. Let me show you what that looked like in real life for one of our clients. One of our clients was earning a little over $400,000 a year as a W-2 earner. Good income, good good career, had a great CPA, filed on time every year, and still felt like taxes were constantly higher than they should have been. When we looked at the situation, the problem was not the return was wrong. The problem was there was no real planning happening during the year. And there was no strategy around the HSA, no charitable bunching, no coordinating RSU withholding adjustments, no tax loss harvesting rhythms, no side business structure to unlock deductions that should have been there. See, on paper, everything looked normal, but in practice, they were quietly overpaying. And once we changed the timing and structure, the outcome changed dramatically. We helped them use the HSA properly. We helped them bunch charitable deductions through a better structure. We tightened up the RSU planning and withholding. We added more intentional loss harvesting coordination. And we introduced a legitimate side business structure that opened up real deductions. None of those moves were risky loopholes. They were all simply the right moves made at the right time. And the result was a significantly lower tax bill. That's why the savings did not come from something flashy. They came from better timing and year-round planning. So if you want to avoid making the same mistakes, here's the real fix. The answer is not complexity, it's better timing. That's literally it. Stop treating taxes like an April event. Start treating tax planning like a year-round system. That means checking in throughout the year. Not obsessively, not every day, but intentionally. Review major income events, deductions, investments, business activity, and documentation. That's how real smart W-2 earners operate. They don't wait until the return is being prepared to ask, what can I do? They ask the question while there's still time to do something about it. That's the real fix. Tax planning is not a season, it's a system. And once you start treating it that way, the final outcome can look completely different. And if you want help building that system the right way, here's the next step. If you're a high-income W-2 earner making over $300,000 a year and you want help building a personalized tax strategy like this, where the right moves are made throughout the year, not discovered after it's too late, then use the top link in the description to book a free tax strategy call with my team. If you'd rather keep learning first, watch the video on the next screen. Every way W-2 earners can lower their taxes, all 100% legal. Because once you understand the timing behind tax planning, the next step is understanding all the legal strategies you can actually use. And remember, the biggest tax mistake usually is not what you do in April. It's what you did not do before December.